Thank you. Greg Robb, MarketWatch. Mr. Chairman, thank you. You haven't had a very good time in all the Republican presidential debates. And I was wondering if I could have your comment on what you've heard. And some of the analysts I talked to said that one of the reasons for this hostility, perhaps, is that a lot of the Republican primary voters are on fixed incomes and have an inability to invest and make money with their funds. So could you talk to them as well? And one more thing, if Republicans take back the White House in November and ask you to resign, would you?
So I'm not going to get involved in political rhetoric. I'm just going to stay completely away from that. I have a job to do, and as long as I'm here, I will do everything I can to help the Federal Reserve achieve its dual mandate of price stability and maximum employment. That's my answer to the last part as well. I'm not going to be thinking about hypothetical situations in the future. In the case of the of savers, we think about all these issues, and we certainly recognize that the low interest rates that we're using to try to stimulate investment and expansion of the economy also impose a cost on savers who have a lower return. And we do hear about that, obviously, and we do think about that. I guess the response I would make is that the savers in our economy are dependent on a healthy economy in order to get adequate returns. In particular, people own stocks and corporate bonds and other securities as well as, say, Treasury securities. And if our economy is in really bad shape, then they're not going to get good returns on those investments. So I think what we need to do is often the case when the economy goes into a very weak situation, then low interest rates are needed to help restore the economy to something closer to full employment and to increase growth, and that in turn will lead ultimately to higher returns across all assets for savers and investors. So I think that's how we would explain it. But again, we recognize that during periods like this, savers are getting a lower return. One reason why it's extremely important for us to maintain price stability, of course, is that at least that minimizes any losses due to inflation that savers might suffer.
We'll go to Donna here, then to Mark.
Hi, Chairman. Donna Borak with American Banker. Shifting a little bit, I'd like to take a look back to the rules that the Fed released back in late December. Obviously, it was a mammoth task for Fed staff to put forth and considered the heart of Dodd-Frank. There were certain provisions that were left out, including the liquidity requirements, due largely to the fact that there's global consensus needed on those rules in the Basel III process. But I was hoping you could expand a little bit more on the decision for Fed staff to forego specifying what the additional capital requirements would be for those banks that were not necessarily deemed G-SIBs, at least now, but we're still above the $50 billion threshold, and to talk a little bit about what the core issues are in deciding whether or not that additional capital should come in the form of a surcharge, what that surcharge might look like, and when we might know. Thanks.
Well, you're referring, I think, to the 165, 166 rules, which will focus on the supervisory oversight of the largest banks. It's a very big and complicated rule, as everyone knows, and so our position at this time is that we would still like to get feedback from the industry and from the public about what the best approach is. So we put out a lot of questions, and we'll be considering those during the comment period and after as we put together a rule. The notion of the surcharges is that banks which do not pose significant threats to the systemic stability of the United States, should not have a significant surcharge. We're required to consider these issues by Dodd-Frank, but our view is that it's the largest banks, the ones whose failure would endanger our financial system, that should be subject to these surcharges. First, because we need to have them be safer than smaller banks, and secondly, because we want to try to equalize the cost of credit that they face. In other words, a bank which is thought to be too big to fail gets an artificial subsidy in the interest rate that it can borrow at, and by having additional capital requirements, that tends to equalize the cost of funding to different banks and reduces the incentive of banks to get large just to create the impression of being too big to fail. So we think those are important, and we'll continue to work with them. The Basel Committee has provided some sense of the range of what those surcharges will fall into, and so we're still working on defining exactly the criteria, but you can assume there will be a fairly continuous range between the $50 billion banks and the very largest banks in our economy. As I said, we're getting reactions and comments. We hope to get, early this year, we hope to come back with a clarification on the rule, and of course we're also working hard on implementing Basel III itself, which we want to do during 2012. We want to put out the rule during 2012.
So then Mark Felsenthal and then Robin Harding, and we'll come back over here.
Mark Felsenthal with Reuters. Mr. Chairman, for more than 3 years now, the Fed has conducted policy through extraordinary means, and yet the new information that we have today pertains mostly to an eventual tightening of policy through raising interest rates. Why is there no new information about the size of the Fed's balance sheet, and what should anybody looking at your communications today deduce about an eventual expansion of the balance sheet through more asset purchases?
So we will be providing in our minutes and in our survey of economic projections, which will be released in 3 weeks, we'll be providing some additional qualitative information about participants' views of the balance sheet going forward. The reason that I can't provide all that information now is basically that we received, a whole range of qualitative comments, and we had further discussion during the meeting yesterday and today, and so, we're going to need a little time to summarize that and to have it approved by, the minutes, of course, and the SEP are approved by the entire committee, and so in that respect, it'll be a definitive statement about what we currently know about the balance sheet. I can say a few things. One is that it certainly remains expanding the balance sheet certainly remains an option, one that we would consider very seriously if, in particular, if progress towards full employment was continued or became more inadequate, or if inflation remained exceptionally low. So we'll continue to look at that. As we say in our statement, we're prepared to take additional measures in general, and that would be certainly one class of measures we would want to consider. I can make one additional point, which maybe wasn't obvious, which is that in June we provided some principles relating the sales of assets, ultimate sales of assets, to the path of interest rates, and those remain in force. Those principles remain in force. And so one implication of our extension of our expected point of takeoff to late 2014 is to imply that the initial sales from our balance sheet, which again are far down the road, but when that begins, that'll be later than previously thought. That'll be presumably in 2015. So we do expect to hold our balance sheet at a high level for a longer period. Additional purchases remains a topic that we are still debating, and it will depend both on our assessment of the efficacy and the risks of that particular tool, but also of how the economy is evolving.
Derek? Oh, Robin, I'm sorry, Robin, and then Derek.
Robin Harding from the Financial Times. Mr. Chairman, when I look at these forecasts for 2014, the median of the forecasts is, I think, 0.75, and the mean is 1.12%. If I'm to draw a line through these dots, How should I draw it so I best understand what the FOMC is most likely to do? And the second part, in the minutes, you say that the committee will consider further options for improvements to the SEP, the economic projections. Could you tell us a bit more about what further you might do? Thank you.
Well, again, first I want to emphasize that there's no mechanical relationship between these projections and the outcomes of the FOMC decisions. Of course, they're a big input into those decisions, but it's a collective decision. If you want to draw lines, I guess my suggestion would be to look at the median, the middle of the distribution, because we do have a democratic process in the committee, and so the median would give you some sense of where the weight balances against higher, in favor of higher or lower rates. Again, we did note that in support of our assessment of late 2014, which is a committee decision, and of course there was a 9-to-1 vote in favor of that, but that is supported by the observation that 11 of the 17 participants expect the funds rate at the end of 2014 to be 1% or less, and so presumably the takeoff would not be much earlier than that. In terms of future additions, there's a lot of ways we could go. We could provide, for example, more information about the relationship between individuals' policy preferences and their forecasts and so on. But there's nothing specific now that has been decided. We have a very capable subcommittee which is charged with continual assessment and analysis of possible ways of improving our transparency. So we will be looking at additional possibilities, and we would welcome feedback for that matter. But there's nothing specific planned at this point.
Okay, we'll leave Derek, then we'll go to Peter, then we'll go to Darren.
Derek Kravitz, Associated Press. Last night, the President unveiled a plan to revamp and expand the government's refinancing program. Essentially, the Fed released a white paper earlier this month that said that up to 2.5 million homeowners could benefit from this and essentially save $3,000 per year in mortgage payments. Right now, there's a mortgage settlement being brokered between state attorneys general and the nation's major mortgage lenders, something to the tune of $25 billion, much of which would be in the form of principal reduction. In the white paper that was released earlier this month, the Fed seemed to indicate that principal reduction could be helpful, but it was unclear about whether they thought that this was a acceptable or even feasible option. They also made clear that a lot of the proposals that are currently out there eat around the edges, so to speak, when you're dealing with a foreclosure crisis, and a lot of economists agree. Do you think a principal reduction in the form of the major mortgage settlement would do a lot to help the housing crisis? And if not, is there any other alternative proposal that would help?